Hey folks, Dave Nadig, Financial Futurist here at VettaFi. As part of my exploration of Canada, I sat down with Rincon of TD Securities to dig into the market making business and being an authorized participant in Canada right now. We talk about the impact of the interest rate environment on capital allocation. We talk about complex products and how they make the job of being a market maker even more difficult than it already is. I learned a ton in this conversation. I hope you do too. Cheers. What's it like being a market maker in AP in Canada? You've been doing it a very long time. I know it's not the same as it is in the US and in Europe. You have experience in all of these markets. What's really unique about your position and the role of a firm like TD in the Canadian ETF ecosystem?
The way we view it here in Canada is really about partnerships. So instead of just making markets on the most liquid ETFs in the US or in Canada, and try to make money through spread or whatever it is, we look at it more as a partnership with the issuers. And we will make sure that we're covering their entire lineup and at the same time making sure we're providing liquidity to the ETFs, but we're also helping them on the distribution side. As you know, the banks own most of the distribution.
Yeah, I mean, that's the whole distribution market here, right?
Exactly. So because of that, we pair up with a lot of our clients in making sure that we help them with their ETFs and pushing those products within our channels, be it our direct channel, be it our advisor channel, or also be our institutional clients, for example.
So that marrying of distribution and other investment services, I mean, heck, VettaFi sort of in that position too. We've got an indexing business. Where do the conflicts show up? Like where does it become difficult? Are there things that issuers ask you to do that are difficult to do? Are there things that you want to do that issuers find difficult to say yes to? Yeah. This is an incredibly cordial market. It's one of the things I love about the Canadian market. But inevitably, there must be places where you have to negotiate around those things.
100%. And like I said, I have two hats, basically. One is a traditional market maker, right? So I need to make sure that I can get in and out of a position and the traditional trading role. But then the other side, I'm a relationship manager. Right. And that's where it gets a little bit tricky, right? Like I have to go and talk to clients and they want to launch an ETF that might not be easy to quote on. Might be an ETF that might or might not be successful. And that's where it gets a little bit more tricky and where we have to have these discussions with our clients here about establishing partnerships and relationships across the dealer. So that's where it gets a little bit more tricky on that side. And then the hard asks are when their products are fairly complex. And then,
well, but that's Canada. Like Canada is the home of complex products.
That's right. And so we have to deal with that all the time. It would be nice if everything is just like a traditional long equity fund with U.S. stocks, which anybody can trade.
Right, with nice wide spreads so that you can be inside them and still make a lot of money.
Never.
Doesn't work that way.
Doesn't work that way because there's a lot of those already, right? So, everything that's new is around the edges. So we're looking at derivatives-based products. We're looking at exposures that are a little bit more complex. So this year, in terms of new launches and new money, a lot of it's going to active. And a lot of these active strategies are not your traditional just long equity. They're going to be a condensed basket of international or long short or derivatives-based. And that's where we're seeing a lot of the growth, and that's where a lot of strain comes to us as a market maker.
And in Canada, with those active strategies, I mean, we should point out, active's been here first, right? It's always sort of been baked into the rule set. The ability to sort of be disparately transparent has kind of always been part of the rule set here. And so you're something like 20% active funds or something like that?
We have it around 26, 27%.
Yeah, it's huge.
So a quarter of the market is actively managed.
And you guys are doing the sort of authorized participant work on that. Oftentimes not fully knowing basket composition, what's in the fund, with some of it being complex, like some of this is short, some of it's international, some of it's derivatives, but you don't necessarily know. How in the world do you manage a risk profile when you don't really know the underlying basket? You're dealing with multiple asset classes. That sounds like a crazy part of the job.
And that's the hard part of the job. You could put it as an operational job, making sure all the kind of like the ducks are in order, and we spend quite a bit of time making sure that all that settles correctly and whatnot. So that's a big part of it, the operational side. The other side is the hedging side, and how do you actually have an ongoing market on something that's really complex, as you just mentioned. And Yes, there are products in Canada where we don't know what's in the basket on a continuous basis, on a daily basis. Most of them do. Most of them are transparent to market makers across the board. So I would say the vast majority are. But a small subset, especially on the active side, wouldn't give us necessarily all the holdings, and it becomes quite hard. And we used to have proxies, we have to have volatility controls, and put our own ranges and metrics around these strategies based on historical values. And that's how we often make markets based on previous NAV days and volatility spreads around those values. So then now, obviously, that leads to bigger spreads in a lot of these products.
And presumably that would have to mean that when one of these products first comes to market, it's going to get quoted barn door wide until you understand how it's going to perform. I mean, there's no way it would not, right?
And actually how it works, it's you start like this, and then it starts going like this, and you add a lot more market makers to it, and then you get retail if it becomes really popular, which in some cases these are, and they become tight. But then all of a sudden, some of these funds will hold X, Y, and Z, which blows up, and the spreads will do this, and then they will do this. So it's a bit of an accordion going back and forth.
It's like breathing.
Yeah. And so we do see some of that in Canada. Funny enough, there are some ETFs that are like that are non-transparent on a daily basis to the market makers, but they're so popular with retail.
They're still tight.
They're still relatively tight, and I wouldn't say they're all like that. For the most part, they start fairly wide because it's a big risk to us. At the end of the day, as a market maker, I'm not exactly hedging myself perfectly like you generally would.
Yeah.
And that obviously has a cost. And it's reflected in the spread, it's reflected in how much we're quoting in terms of size, for example. Like, we're not going to put millions and millions of dollars on the board, let's say, and multi-quote on an ETF if we have no idea what's in it.
Right, of course.
So
of course.
while if we have full certainty and we know the fair value of the ETF, obviously we're going to do our best to put as much size in the market as possible.
You mentioned that it's going to cost something. I feel like there's a bit of a thing hanging over this, which is the cost structure of the market making business has to have been radically usurped in the last 2 years with a rising rate environment. Are you finding yourself able to still do your job when I'm sure your internal cost of capital has gone through the roof because interest rates are up?
Yeah, and like the ETF business tends to be a low balance sheet business compared to other businesses in general. Like,
right. It doesn't take $1 billion of TD's balance sheet to keep the market making business alive.
Our business to get in and out, as you know, and we create and redeem as much as possible. So we hold as little inventory as possible. So naturally, compared to other desks, we're lower balance sheet, but we still need balance sheet. So the rise in rates has definitely impacted how we manage our book, what we want in our book, and how often we're quoting. Because the more we are posting bids and asks, the more we're getting filled and the more inventory we're holding, right? Which is also what's led to a huge shift in P&Us in Canada, or like how much the minimum creation size for an ETF. And there is a limit on the size or a floor on the size because you don't want to create in $1 or $20.
Right, yeah.
It's too much operationally.
Right.
So the issuer will say, well, once you get to $100,000, or just
whatever the
whatever number is, $1 million or whatever it is.
Yeah.
Generally the bigger the ETF, the bigger the number. But once you get to this threshold, then you can create. So those numbers have come down. The issuers have welcomed the lower P&Us so that we can hold less inventory in our books.
So from your perspective, if you could be doing creates and redeems on $100,000 or 10,000 shares or something, you'd do it all day long.
Oh, because it's almost automated for the most part. Like the process, yeah, we would want to get out of most of our inventory. We're not in the business of taking views in the market or having stuff on our books, right?
Right. So when you guys really earn your keep is when you can't do that. When you need $100 million and you've got 5 to trade,
100%.
That's when you guys really have to earn your
or
keep.
with seed.
Right.
Sometimes there's been scenarios where we've held seed for long periods of time, and this is costly because the hedge costs money. Like if you're short, you need to there's borrow costs, and there's also balance sheet costs on the other side. So both sides of the transaction, the long end and the short end, have costs.
Do you feel like that's a sort of a damper on innovation in the ETF space? Because that just sort of implies the bar for what's a good idea has to be higher because the cost of doing it is now higher as well.
100%. And I think you and I were talking about this, and that the threshold to launch a new ETF has definitely become higher. It's become tougher to launch an ETF as a new issuer. It's become much harder to become a new issuer in Canada. If you go back pre-COVID, let's say, you saw a lot of new issuers coming in excitement, and the bar was much lower, which is how much it cost to get in and how successful you had to be. Now it's fairly high, I would say, and there's a lot more no's happening and a lot more firms that are trying to get in that can't get into the ETF space because the cost of capital is much higher, and it's so much harder to add in more and more to the technology.
Talk to me a little bit about the complexity part of that, because I'll just pick two things. The use of derivatives, through the roof in Canada in ETFs versus in the US. It's just become a thing in the US in the last couple of years. And multi-asset class product, whether they're asset allocation sort of portfolio product or products that are trading against asset classes. All of those have got to make your job more difficult. How do you balance that out? How do you think about the complex products versus the easy long equity ones?
Yeah, and to put it into context, you did a good job of that in that we're a smaller market in the US, right? So we're catering to fewer dollars going in and out of the ETF every day.
But it doesn't make the job any easier.
It does not. And at the same time, we're making markets on crypto, commodities, carbon credits, equities, fixed income, preferred shares, so the whole gamut of asset classes.
Internationally, in every market in the world.
International,
Yeah.
And it's much, so the build is the same, but the revenue potential is lower because you only have a few products that you're looking at. So it can become quite complex. And you mentioned two products specifically. You said asset allocation ETFs. So it's a huge growth area here in Canada, especially amongst retail. Retail really eats it up, and they love asset allocation ETFs. So here at TD, our direct investing channel, we see a ton of flow in asset allocation ETFs. And these ETFs have a bunch of other ETFs. They have fixed income ETFs. They can have crypto ETFs in them, which we know some do have. And so it is quite complex to make markets in so many different areas, which adds more to the strain, which means that we have need more expertise on the desk. So we actually have it separated by asset class, and we do have specialists in the different areas. And the other one is long short or liquid alts in general. I'm going to phrase them as liquid alts. So
sure, yeah.
A couple of years ago, the 81102 changed here in Canada, which allowed mutual funds in general to be able to trade or have a lot of the same exposure as a hedge fund to some degree, so a higher degree of leverage, high degree of borrowing, and at the end of the day, a little bit more complex. So since then, we've seen a huge proliferation in liquid alts in Canada. So we have a ton of long-short strategies, derivatives-based strategies, what we call boosted ETFs, which are not that common.
A little bit of leverage. Right.
It's become very popular here in Canada too, and obviously, once again, going for more yield. So when you add all those up, then you're adding prime relationships, you're adding derivatives relationships, and you have to put all these together inside a package, and we have to quote on it. And actually, it's quite hard. Like we have ETFs here in Canada that have 1,000 lines, and they're not bond ETFs. And these are 1,000 lines of options, futures,
short positions,
currencies, and it's a whole soup of stuff. And it's very hard to make markets one-to-one on these ETFs. So what the street does well, but it's a strain, is you have to use proxies. You have to have a lot of different ways to mimic the exposure that these ETFs specifically are looking.
Is there something that retail needs? Is there something that the retail market in Canada really needs for the ETF industry to be successful? Is it a product type? Is it education? Is it distribution? What is it? What does the retail market here need?
I think the retail market needs a lot more enthusiasm for local products. We have a lot of our investors here in Canada, institutional and retail, invest in U.S. ETFs, and the Canadian market is growing quite substantially too. But what would be great is if a lot of the ETFs in Canada become superstars. So we have a couple of superstars in Canada, obviously I'm not going to mention, but some that have grown quite substantially, and they become the norm or become the thing to look for when it comes to broad market ETFs, let's say. We need more of those in Canada. We need more ETFs that are very well known. In the same way that you have SPY, VOO, or many other ETFs in the U.S. That are very well known and very often quoted. We need more of that in the news, and for the Canadian investor to first rely on the local product.